June 16th, 2026. Right now, millions of investors around the world are searching for the next life-changing opportunity. They're scrolling through social media, watching finance channels, reading headlines about artificial intelligence, trillion-dollar companies, and revolutionary technologies that promise to reshape the future. Somewhere among those investors is a person who believes they've finally found the perfect stock. The company looks unstoppable. The story sounds incredible. The future appears guaranteed, and that's exactly why they should be careful. Because throughout history, some of the biggest investing mistakes have started with the exact same feeling. The feeling that success is obvious. The feeling that everyone else is getting rich. The feeling that if you don't act immediately, you'll miss the opportunity of a lifetime. Every generation experiences this. In the late 1990s, it was internet companies. In the mid-2000s, it was real estate. In the early 2020s, it was electric vehicles, meme stocks, and later artificial intelligence. The technology changes. The companies change. The headlines change. Human psychology does not. Investors become excited by stories. Stories become narratives. Narratives become movements. And movements become bubbles when expectations grow faster than reality. Now, don't misunderstand this point. Many of these technologies truly are revolutionary. The internet changed the world. Smartphones changed the world. Artificial intelligence is changing the world right now. The problem is not innovation. The problem is the price investors are willing to pay for that innovation. Because eventually, every investment comes back to one simple question. What would this company have to achieve for today's price to make sense? Most people never ask that question. Instead, they ask how high the stock can go. They watch the price chart. They see a stock rising every week. They see influencers posting screenshots of massive gains. They see experts making predictions about trillion-dollar valuations. And gradually, they stop analyzing the business itself. They start analyzing the excitement surrounding it. That's where things become dangerous, because stock prices can rise much faster than businesses grow. A company might increase its revenue by 20%, but its stock price might rise by 200%. A business might become more valuable, but not nearly as valuable as investors suddenly believe. At some point, the story becomes larger than reality. That's when risk quietly enters the picture. Imagine a company generating billions of dollars in annual revenue. Investors love it. Customers love it. Analysts love it. The media talks about it every day. Over time, its valuation climbs higher and higher until people stop discussing whether it's expensive. Instead, they discuss whether it can become the biggest company in history. Notice how the conversation changes. The debate is no longer about value, it's about possibility. Investors stop asking what the company is worth today and start imagining what it could be worth 10 years from now. That shift sounds harmless, but it creates one of the biggest traps in financial markets. Because the future is uncertain. Every company faces competition. Every industry changes. Every technology evolves. Yet, when excitement reaches extreme levels, investors begin pricing companies as if success is guaranteed. They assume everything will go right. They assume growth will continue forever. They assume the future will unfold exactly as planned. Reality rarely cooperates. Even extraordinary businesses encounter challenges. New competitors appear. Economic conditions change. Governments introduce regulations. Consumer behavior shifts. Markets become saturated. Growth slows. These are normal events in business. Yet investors often react as though they were impossible. That's why some of the most impressive companies in history have delivered disappointing returns for investors who bought at the wrong price. The company succeeded. The stock did not. The business grew. The investment struggled. Those outcomes can exist at the same time. And that's something many new investors fail to understand. A stock is not simply a company. A stock is a company plus the expectations attached to it. The higher those expectations climb, the harder it becomes to exceed them. Now, let's talk about how market hype actually works. Most people imagine financial markets as a level playing field where everyone receives information at the same time and makes decisions independently. Reality is very different. Different groups enter opportunities at different stages. Early investors discover companies before they become famous. Professional funds conduct research long before headlines appear. Venture capital firms invest years before public attention arrives. By the time a company becomes the center of social media discussions, thousands of people have already established positions. Think about that for a moment. If everyone is talking about an opportunity today, someone found it yesterday. If everyone wants to buy now, someone bought earlier. The crowd rarely discovers opportunities first. The crowd usually discovers opportunities after they've already become popular. This doesn't automatically mean the investment is bad. It simply means the easy gains may already belong to someone else. Yet many investors confuse popularity with safety. They see millions of people discussing a stock and assume that level of attention reduces risk. In reality, widespread enthusiasm often increases risk because expectations become inflated. When everyone expects success, there's very little room for disappointment. That's why market psychology matters so much. Rising prices create excitement. Excitement attracts buyers. New buyers push prices higher. Higher prices create even more excitement. This cycle can continue for months or even years. Eventually, investors begin treating price increases as proof that the underlying thesis is correct. The stock is going up, therefore the company must be worth it. But price movement is not evidence. Price movement is simply activity. Throughout history, countless assets have risen dramatically before collapsing. Tulips, housing markets, technology stocks, cryptocurrency booms, meme stocks. The pattern repeats because human behavior repeats. People become confident when they see others making money. Confidence creates demand. Demand pushes prices higher. Higher prices create even greater confidence. Few people stop to ask whether the underlying assumptions remain realistic. That's why the most valuable skill in investing isn't predicting the future. It's evaluating expectations. Whenever you see a company dominating headlines, ask yourself what assumptions are already reflected in the price. Does the valuation assume years of uninterrupted growth? Does it assume market dominance? Does it assume competitors will fail? Does it assume customers will remain loyal forever? The more optimistic those assumptions become, the more fragile the investment can be, because even small disappointments can trigger major declines. Imagine a company expected to grow 50% every year. If it grows only 35%, that's still incredible performance. Yet, investors may react negatively because reality failed to match expectations. This is one of the strangest aspects of financial markets. Great results can lead to falling stock prices if investors expected even better results. That's why understanding expectations is so important. Markets don't reward companies for being good. Markets reward companies for exceeding expectations. And when expectations become unrealistic, even exceptional businesses struggle to satisfy investors. The next time you hear someone describe a stock as a guaranteed winner, remember this: nothing in financial markets is guaranteed, not because great companies don't exist, but because prices matter. The difference between a smart investment and a bad investment is often not the company itself. It's the price paid for future success. The wealthiest investors in history understand this principle deeply. They don't ask whether a company is exciting. They ask whether the excitement is already reflected in the valuation. They don't chase headlines. They analyze assumptions. They don't rush because everyone else is rushing. They wait for opportunities where reality is stronger than expectations. That's difficult because patience feels uncomfortable. Watching others make money feels uncomfortable. Ignoring popular trends feels uncomfortable. Yet, investing success has always required the ability to resist emotional pressure. The market constantly rewards excitement in the short term and patience in the long term. That's why many investors spend years chasing the next big thing, while a small group quietly compounds wealth through discipline. So, as you look at the biggest opportunities of 2026 and beyond, remember the question most people forget to ask. Not whether the company is amazing, not whether the technology is revolutionary, not whether everyone else is buying. Ask what the business would need to achieve for today's price to make sense. That single question can protect you from costly mistakes, keep your emotions under control, and help you focus on reality instead of hype. Because fortunes are rarely destroyed by investing in great companies. They're destroyed by paying extraordinary prices for extraordinary stories and assuming the future will unfold perfectly. The headlines will change, the technologies will evolve, new market sensations will appear, but the mathematics of investing never changes. Price matters, expectations matter, and patience remains one of the most powerful advantages any investor can possess. But there's one final piece of this puzzle that almost nobody talks about, and it may be the most important lesson of all. The market doesn't care how badly you want a stock to succeed. It doesn't care how many analysts are bullish. It doesn't care how many influencers are calling it the opportunity of a lifetime. Eventually, every story collides with reality. Every prediction faces results. Every expectation meets the numbers. And when that happens, only one thing matters. Was the business able to deliver what investors already paid for? That's why some of the biggest winners in the stock market weren't necessarily the most exciting companies at the time. They were often businesses that quietly exceeded expectations year after year, while everyone else was distracted by the latest trend. The truth is that wealth is rarely built overnight. Most fortunes are created through patience, discipline, and the ability to think independently when everyone else is reacting emotionally. The next market craze will arrive. The next trillion-dollar prediction will appear. The next stock that everyone claims can only go higher will dominate headlines. When that happens, remember what we've discussed today. Don't ask how much money other people are making. Don't ask how high the stock could go. Ask what the market is already expecting. Ask whether those expectations are realistic. Ask whether you're investing in a business or simply buying into a story. Because the investors who survive and thrive over decades aren't the ones who chase every opportunity. They're the ones who understand which opportunities are actually worth chasing. And that single habit can make the difference between building wealth and becoming exit liquidity for someone else. So, before you buy any stock, take a moment, slow down, and do the math that most people skip. The answer may not be exciting, but it could save you years of regret and thousands of dollars. If you enjoyed this breakdown and want more videos that expose the hidden psychology, valuation traps, and money-making opportunities that most investors never see, make sure to subscribe, turn on notifications, and join our community. Because in a world full of hype, noise, and emotional investing, knowledge remains your greatest competitive advantage. Thanks for watching, and I'll see you in the next video.